Welcome to PhillipCapital Weekly Market Watch. I'm Camelia, Business Development Dealer from Phillip Futures. For this week's episode of Market Watch, I'll be focusing on crude oil production. Crude production has been on the rise even though crude prices have fallen by more than 50% over a period of 6 months since June 2014. Based on the chart of the weekly US crude production, the latest figure shows that US is producing crude at an all-time high of about 9.4 million barrels a day, an output level not seen since the 1980s. With these strong production figures, many of us might be curious as to why crude production is still so strong despite oil prices being so low right now. Looking at the drilling activity chart, there is a significant decrease in the number of oil rig counts from about 1,300 to 800 from September last year to January this year. With the low crude prices, it is inevitable that some oil rigs have to be shut down as production costs might be too high to sustain production. However, we might see that the crude production did not drop as a result of the decrease in rig counts. This is similar to the time dating back to year 2009, where there was a significant drop in rig counts but crude production still holds steady. In order to give you a better picture, we have included the US crude production figures into the chart. We believe that there are two main reasons for this strong crude production figures. Firstly, we believe that the drops in oil rigs come mainly from the cutting of inefficient wells. When oil prices are low, firms tend to cut the unproductive rigs, and thus drop in rig counts does not have much impact on the total crude production at the start. Secondly, we are seeing increased new well production per rig. This is a representation of the efficiency for new rigs, and that even with lower number of rigs, this does not necessarily mean that the total crude production would be low. Therefore, by cutting off inefficient rigs and channeling the drilling efforts into more productive rigs, it has managed to sustain and even surpass the high US crude production output level as seen on the chart. However, moving forward, this strong crude production figures should not be sustainable, as it is going to be increasingly difficult to find profitable wells when benchmarked with the low crude oil prices. With this difficulty, we believe that the total crude production should fall in the near future. Currently, the crude oil market appears to be trending into a very broad trading range of about $45 to $65 per barrel in terms of the WTI crude oil. Focusing solely on the crude production angle, we believe that for oil prices to break out from its current bearish trend, we will need to see a steady drop in crude oil production figures. However, we will also have to keep an eye for production from other major producers like the OPEC countries. If their production were to rise, this could easily dampen drop in the US crude production and could bring us back to square one. With this, we have come to the end of this week's edition of Market Watch. For more information on the risk and return of investing in crude oil markets, you may approach any representative from Phillip Futures. Please subscribe to us on PhillipCapital YouTube channel and Facebook, and stay tuned for more Market Watch videos. Thank you.